I have a small announcement. We will have a TA hour Wednesday. So 5 p.m. Wednesday, March 16. I don't have classroom. I didn't reserve a classroom yet, but I will make an announcement as soon as possible. Unfortunately, this is TA hour, so my TA will explain R, how to start R, and how to handle data. He will cover very basic comment about R, okay? And I strongly advise you to attend this TA hour. Unfortunately, it is available only in Korean. I'm sorry. So yeah, actually my TA very mind teaching in English, so it will be only in Korean. So for those whom cannot understand Korean, I'll make a separate arrangement if possible. Okay. So how many students can attend this TA hour? Could you please raise your hand? So one. Beg your pardon? Yeah, can. Will be able to attend this class?
I have class that day.
Oh, you have class that?
Class ends at like 5:30.
Until 5:30? Okay.
My class is until 7 o'clock.
Okay. Okay, we will have a TA hour at this time as is scheduled, and for those who cannot attend or cannot understand Korean, I hope I can make a separate arrangement. Okay. So again, could you please raise your hand if you will be able to attend this class? Okay, 1, 2, 1, 2, 3, 4. Okay, thank you. Actually, yesterday so very important news about PIMCO dumping all U.S. bond. Actually, I think that's very important news and have a large implication to our class. Do you know what PIMCO is? Have you ever heard about PIMCO? What is PIMCO? Can someone explain to me? Yeah. PIMCO. Do you know what it is?
No.
No, never heard of it? Large bond dealer. Actually, they are not a dealer. Okay. So, whenever you have a question, of course, we can search on Google. Okay. PIMCO. Okay. Oh, it's a neighbor. Sorry. Okay. So PIMCO, so it is a company webpage, and let's check Wikipedia. So Pacific Investment Management Company, okay, it's a global investor management firm. So it is basically asset manager, and it is very famous for actually bond management. It is actually the largest bond manager, okay, in the world, by large margin actually. It is actually largest bond manager, and it is most successful actually asset manager in the world. Its founder is Bill Gross. He is known as a bond king. Okay. So let's look at the news.
Hey, I'm not a big fan, I'm a reporter, but I'm excited about CNBC Pro. You can get real-time access to CNBC with real-time information, an unlimited number of spots that you can watch, an unlimited number of watch lists.
Go to pro.cnbc.com/info.
Some big-time bond news today. Investing powerhouse PIMCO has dumped all
of its U.S. government-related securities. All of them. Now, the news wasn't a total surprise, given that PIMCO chief Bill Gross's recent tough talk that treasuries are way overvalued. Take a listen.
Those are the most overvalued simply because the Federal Reserve has been maintaining a policy rate, a Fed funds rate of 25 basis points for over 2 years, and secondly because they've been buying lots of treasuries on the open market.
All right, so does Mr. Gross have the story right? Is the Bernanke's ultra-easy policy fueling inflation and hence a bond bubble that will be birthed with much higher long-term rates? Here now is CNBC contributor and Trend Macro Chief Investment Officer Don Luskin. We also have Michael Pinto, Euro-Pacific Capital Senior Economist. Gentlemen, before we start, I want you to hear Mr. Rex Tillerson, the CEO of ExxonMobil, the most powerful oil company in the world. Take a listen. To his take.
From my perspective, as things approached $4 a gallon gasoline, and as you hit $4, it was like that was the straw that broke the camel's back for many consumers. Psychologically, but also managing their household budgets. Extra $50 a month in gasoline costs may not sound a lot to a lot of people. For a lot of people's household budgets, that's a problem.
All right, one of the great CEOs, one of the great corporations around the world. He is raising a deflationary point, Don Luskin. So I want to ask you regarding Mr. Bill Gross's surmise that bonds are a bad place to be. He's talking about Treasury bonds. He's expecting long-term interest rates in the Treasury market to go up quite significantly. Ms. Tillerson, on the other hand, raising the issue of the slump in growth and deflation. Where do you come out, Tom?
Well, I think what Tillerson's talking about is not necessarily deflation in the sense of the price level coming down. I think he's talking about the idea of a recession or a contraction being brought on by high gas prices, just like a classic oil shock. What Gross is talking about is something entirely different. Gross is talking about a liquidity effect that will happen at the end of June when the Fed stops buying treasuries. He's looking at basically a technical phenomenon. It has nothing to do with inflation or deflation. He's assuming that when that big buyer in the treasury market stops being in that market, that yields will skyrocket because no one's supporting the market. However, there is nothing supporting that belief because this is now the third time that the Fed is engaged in large-scale long-term asset purchase programs. The last two times when they terminated those programs, fixed income markets just didn't even notice. So I'm actually not worried about that.
All right, you're not worried about that. Let me ask you, Mr. Pinto, are you worried about that? Now look, Bill Gross, a very astute investor, no one's perfect in the world, but he's basically saying there is a monetary and credit bubble. Whether there's inflation in that, I'm not sure if Gross is saying that, but he's saying get out of treasury bonds and that their rates are going to rise. What's your take?
Well, I think Gross has it exactly right. The treasury market is going to be overwhelmed by inflation and supply. Now, I know some people don't want to look at commodities, they want to ignore gold prices, but let's look at the pre-Boskin measurement of inflation. If you look at that, it says the CPI is now 9% year over year. That's huge. And have you looked at the ISM manufacturing survey? These respondents are saying the dollar is sending prices much higher. And they're saying they're seeing broad increases in inflation. That's not Michael Pinto, that's the ISM saying that. And how the heck can a central banker create $2 trillion worth of credit out of the blue and buy bank assets and that not depreciate the value of the dollar? End of the story. We have inflation.
All right, hang on. It's at the end of this story because we're going to get Don Luskin's point of view. But I want to ask you, Michael Pinto, if Treasury rates, which are currently about 3.5%,
on the 10-year.
On the 10-year, okay, the benchmark. If they go to 4.5% or 5%, quickly, please, what will that do to the stock market?
I think it'll send it much more lower. They're going to 7%, not 4 or 5.
So Don Luskin, now we're at a 7% 10-year treasury that is going to decimate the stock market. Would you like to weigh in? Do you want to call? Do you want to throw a few words?
Well, who's going to disagree that if the good tooth fairy just comes down and waves are one and all of a sudden the 10 years at 7%, yeah, it's just going to be a stock market crash. That's not going to happen. Even Bill Gross is only talking about treasuries going to 4%, in which case he's already missed 2/3 of the moves. They were 2.5% just last August. So this is not a big deal. This is a good deal. This is called growth coming back. It's 4% is a perfectly reasonable, benign, wonderful 10-year rate for an economy that finally, thank God, is growing again.
Yields higher, though, Don. It's inflation that sends yields higher. It's supply that sends yields higher. Let me just say, the February budget deficit was 200. It was a rhetorical question.
No, this is a question. You asked a good question. I want Don Luskin to give a good answer. Go ahead, Don.
Well, I'm not sure I really understand the question because we have. I basically sympathize with what Mike is saying. I understand that the gold price signal, which I have followed all my career, has been flashing an inflationary warning. I understand that deficits have been flashing inflationary warnings. But we've got to be scientific about this. We've got to look at the inconvenient truth that these warnings have been flashing nonstop year after year after year after year, and the house just never burns down. Michael, you and I were both worried when gold sailed through 600 and 700, 800 and 900. Now it's almost 1,500. Where's the inflation? The only place where we can find it is by making suppositions that our statistics are somehow being influenced.
Let me go back to the word, Dave. You know, it's my opinion. My opinion doesn't matter. It's not the data. The February budget deficit was $223 billion. That was more than the entire yearly deficit of 2007. Okay, the publicly traded portion of the debt has increased 95% since the end of 2006. Is there just an unending supply of savings across the globe that can be squandered into our bond market? I mean, if the Fed is just buying most of this Treasury debt, that's inflation. That's going to send yields higher.
Real quick,
supply and inflation.
Real quick, Don.
Michael, when you and I were making these very same arguments with these very same words over and over for 4 years ago, 5 years ago, 6 years ago, why didn't it come true? We've got to understand the answer to that question and stop just going along with these religious propositions. It's obviously not really happening.
All right, so you don't think it's going to happen? You think it's absolutely will. Rex Tillerson does not think it's going to happen. Bill Gross of PIMCO does. We're going to have to leave it there, so this debate will go on. You two are terrific. Don Luskin, thank you. Michael Pinto, thank you. Very clear views.
Today we will prepare nameplate. Where is your nameplate?
I'll get one done now.
Yeah. How are you? Your nameplate? What is your name? Oh, it is your first time in the class. Who are the first time in the class? Okay, oh, there are many. Okay, and you too. Actually, in last class, we all introduce ourselves. So if you are first time in this class today, you have to introduce yourself. Why do you class from you?
Hello everybody, my name is Haemin Kim. I'm Mrs. Major and senior. And nice to have you in class with you guys.
Okay. Next.
Morning, my name is Sierra Yu and I'm a student in Department of English Language and Literature.
So did you register the class? Okay, you did. Okay, next.
Hello, my name is Chun Mo-ju and my major is engineering. Nice to meet you.
Okay, next.
Hello everyone, my name is Moise and I'm from Pakistan. I study in, my major is DIS, it's Division of International Studies. Nice meeting you.
So you are exchange student. Okay.
No, I'm regular.
Oh really? Okay, I'm very sorry. Okay, next.
Hi everyone, my name is Nina and I'm here as an exchange student.
Oh, you have very pretty nameplate. Yeah. Okay, can I borrow it? Okay. So this is the benchmark nameplate. Okay, please. Yeah.
That is also my name.
Oh, so yeah, this is both front and back. Okay. The next, yeah.
Hello, my name is Min Sung Park. I'm a senior. We have a nice time together this semester.
Okay, thank you. Yeah.
Hello, my name is Umer. I'm also in DIS and I am junior at DIS. So nice to meet you.
Okay.
Hello, my name is Octavia. I'm an exchange student.
Okay, where are you from?
I came from Indonesia.
Indonesia, okay. And you are due, right?
My name is Mire. I'm an exchange student from France. On my major is
Okay, thank you. So, I forgot your name again. What is your name? You. Yuerang. You are from English department. So, could you please briefly summarize the discussion?
Just entered class in the middle of the clip, so I don't think I can fully understand it. But they are talking about the inflation, which is both coming incident in the United States from one perspective, and the other argues that it won't.
Okay, who wanna compliment her as you thought to her explanation, her summary? How about you? Why don't you try? Yes.
So I was just impressed how strong they argue each other.
Yes, that's the famous Kudlow show. Yeah. Yeah. They always debate very hard in the show.
That's the content really.
Okay, so do your best. Okay.
So I will participate next time.
Okay, so yeah, as I told you last week, I try to make this class interactive, very interactive. Okay, so you should prepare and you should be active in the class. If you don't, actually, I will force you to be active. Okay. So this debate, the debate in the CNBC clip was all about inflation. Actually, whether there will be inflation or not. But actually, that is not our concern. Our concern is actually the relationship between inflation and bond price. Okay, so implicitly in the clip they said that inflationary pressure, actually there is a inflation pressure and that leads to bond bubble. But in the news actually, a lot of cases actually, whenever people have concern about inflation, when people are cautious about inflation, actually that will tank, okay? That will tank bond prices. So what is the exact relationship between bond price and the inflation?
The higher the inflation, the higher will be the coupon rate for the bond.
Why?
Well, basically, with the inflation, money will be depreciating. Money will be depreciating. Thus, investors will demand higher payback for it.
Okay.
Right? So what they've been talking about is basically bureaucrats. They announced that there will be a tenure for U.S. bonds with the higher interest rate, and the other guy was arguing that this all inflation and bond bubble, and it might have some adverse events or something like that. So that's why he was discouraging actually investors to buy those bonds.
Exactly. So basically PIMCO, especially Bill Gross, PIMCO and Bill Gross believe there is a bubble in the bond price. Why there is a bubble in the bond price in the first place? Wouter. Yes.
Why is there a bubble in the bond price?
Yes.
I guess that is caused by the inflation. Then if the inflation rate is too high,
okay,
the money returned from the bond price will not be enough to cover investment.
Okay, basically inflation means that there are too much liquidity in the economy, right? I already explained what is liquidity. I explained 3 definitions of liquidity last class. What I say here about liquidity is actually macro liquidity, okay, macro level liquidity. So it is basically money plus credit in the economy, okay. So why in the first place there are so many liquidity in the economy right now? And why people worry about inflation now?
Because, as he mentioned just right now, central banker somehow created $2 trillion.
Right.
Right. So that's one thing.
So, okay. So why central bank? Okay. Flooded economy with money. Why?
Because the current U.S. economic growth rate is not high enough for them since the crisis, so they're trying to pump in money so that there will be more expenditure and the economy will boost, like from the macroeconomic point of view.
Okay, so it should go back to actually at least, okay, not should, at least goes back to the financial crisis 2 or 3 years ago. At the time, to get over the crisis, U.S. government printed out a lot of money. First, they lowered the interest rate, which means that they bought a lot of short-term treasury bond. And then once interest rate reaches zero, then it means they cannot buy any more short-term bond. Then they started doing something called quantitative easing. Quantitative easing is, it has several meanings, but simply speaking, it means government buy long-term bond. Okay? So usual monetary policy is about short-term interest rate called the federal funds rate is controlled basically in the market by trading short-term government bonds. On the quantitative easing, now they have to buy, they buy even long-term bond. So during that process, of course, there will be a lot of money in the economy. And of course, to buy the bond from the market, US government should pay higher price, right? Higher price to the bond in the economy to absorb those bonds, right? And to put money in the economy. So that leads to economy as well as inflation bubble in the actually to borrow the opinion of PIMCO and Bill Gross that leads to the bubble in the bond price. Any question until now? Now next question is, okay, there is a bubble in the bond economy and due to the inflation concern, okay, Bill Gross and PIMCO dumped all US bond from their portfolio because of the inflation concern. Right? So once inflation is realized, what government should do? What Fed should do? Yesterday, Bank of Korea actually increased key interest rate. Why? Why did they? Yeah.
Because I guess the Korean National Bank tried to make the saving more attractive to just some people, and people will save the money, and it will reduce the liquidity. Liquidity in macro.
Yes, this may be one explanation. Yes, Mihai? Yeah.
I think because currently the oil price is really high and Korea is really dependable on the oil price.
Okay.
And the other thing, they increase the interest rate to make the currency stronger, and in doing so there are going to be no inflation on the market. Otherwise, if they decrease the interest and the oil price going up, the inflation is going to increase.
Okay, that is also related, although actually, officially speaking, Bank of Korea and Korean government are separate, they are independent of each other, right? But no one believes that, I think. I have to be careful, this will be broadcasted on the web, okay? I have to be very careful, but I think a few people would believe that current Korean government officially changed their economic stance. Formerly, they focused on growth of the economy, creating jobs. Now, what is their focus? President Lee Myung-bak made statements only yesterday or 2 days ago, I think. Yeah.
This year, President wants to keep the CPI price index
Okay.
lower.
Yeah, CPI lower. So what CPI measures? Consumer Price Index. Yeah, so what CPI measures actually? Why people create inflation, right? Exactly. So until now, Korean government has focused on growth and job creation, but now they will try to focus on inflation in line with, although not officially, actually in line with that mood. Bank of Korea also increased interest rate actually to prevent further inflation. Actually, inflation is now biggest threat in Korean economy. It is actually very serious. Okay, ask your mom how serious the inflation is nowadays. So anyway, when there is inflation concern, of course, the first thing we will expect is the higher interest rate. Okay, once the interest rate is higher, then there will be higher discount rate. Future money is less and less valuable. Bond is basically contract about future cash flow, fixed future cash flow, right? Therefore, higher interest rate will lower bond price. Therefore, to summarize, Bill Gross and PIMCO sold all their U.S. Treasury debt, Treasury bond, because they concerned about inflation and they think interest rate will be higher, which will lower bond price. Therefore, they sold all bonds from their portfolio. Any question? Then really the question is whether there will be. So currently people concerned about inflation, but the debate in the clip was whether there will be inflation or not. Some people say there will be inflation. The person in the desk, he believes there will be inflation, serious inflation. And another people say it is not a big concern. Any question? No. Okay, today we have a student presentation on Wonhyup, so why don't you do your presentation now? Yes. Yes. Thank you.
Professor, so
beg your pardon?
Does my presentation also record?
Yes, we will be. Isn't it fun?
Good morning, this is Wonhyup and I'm the first presenter. And I upload this presentation on the HYU, so you can download it. And today I cover the introduction of investment theory, but it is the first and second chapter, so there will be a lot of terminology you need to remember, and it might be boring, but please focus on this presentation. What is investment? What do you think? Yeah. There is a definition of investment. Investment is current commitment of money or other resources in the expectation of repeating future benefits. It means you can also understand by using these two examples. First, when you purchase share of stocks, you pay $1 to buy a stock, then you expect to receive more money than you paid. Then when you spend studying a textbook, you need to pay a textbook, and also you have to spend the time, so it's kind of investment. And the goal of the first chapter is separated by 5 topics. And I hope you will find the answer after this presentation. So the first one is define an investment, I said before, and distinguish between real assets and financing assets. Then describe the major steps in the construction of an investment portfolio. Then identify major participants in financial markets. And after that, identify types of financial markets and recent trends in those markets. Okay. And first topic is real asset versus finance assets. Real asset is used to produce goods and service, and lands, building, equipment, knowledge is good examples of real assets. Then finance assets. It is claims on real assets or income generated by them. We can think about stocks or bonds. As you already learned from the latest financial crisis, real assets and financial assets are connected. So you need to remember the success of values of financial assets depends on the performance of underlying real assets. The next topic is taxonomy of financial assets. There are 3 types of finance assets. First, debt. Second, equity. Third, derivative securities. We will cover these following assets a little more than next chapter. So this is just introduction. So think about that. It's kind of paying a specific cash flow over a specific period. So we call fixed income securities. Like corporate bonds and this kind of bonds is a good example of that. And second is equity. It's ownership share in corporation. So common stock is a good example of equity. And derivative securities is security providing payoffs that depends on the value of other assets. You can cover options and future and so on. And let's think about financial markets and the economy. Financial assets and markets in which they trade play several crucial roles in developed countries. There are 3 crucial roles, and the first law is consumption timing. Then the second one is allocation of risk, and the third one is separation of ownership and management. Let's compare the 2 periods. In the high earning period, when you are 20 or 30, you can invest your saving in financial assets. Then in low earning periods, when you are retired, you can sell these assets to provide funds for your consumption needs. The second one, allocation of risk. All real assets involve some risk. So investors are able to select security types with a risk-return characteristic that best suit their performance. You can select Samsung Electronics or POSCO or Hyundai Motors in terms of this situation. So the third one is separation of ownership and management. And the individual elects a board of directors, which in turn hires and supervises the management of the firm. But you need to think about agents program. It's conflicts of interest between managers and stockholders. The next topic is the investment process. types of decisions: asset allocation and security selections. Asset allocation such as stocks, bonds, and real assets, commodities, and so on. Security selection is the choice of which particular securities to hold within each asset class. And there are two types of portfolio you need to remember. The first one is top-down portfolio. It is what proportion of the overall portfolio ought to be moved into stocks, bonds, and so on. And the second portfolio is bottom-up portfolio. It's a kind of portfolio is constructed from the securities that seem attractively priced. So in this situation, the people doesn't think too much about the asset allocation when the bottom of portfolio. The fifth topic is markets are competitive. Have you ever heard about there is no free lunch? The first thing is risk-return trade-off. It means high returns and high risk, high return, or risk for return. And next one is efficient market. Means we should rarely expect to find bargains in security markets. It means every security prices has information. So it says having buying or holding a diversified portfolio is a good investing. And, active management is attempting to identify mispriced securities or to forecast broad market trends and buying the low price and sell the high price. And passive management is having a good portfolio. The next thing is the players in the markets. There are major players, and the first player is funds. The second player is households and governments, and you can think about financial intermediaries and investment bankers. The firms, they raise capital to pay for investment in plants and equipment. So they are net borrowers. The households, we call net savers, they purchase the securities issued by the funds. They need to raise funds. And government is can be borrowers or lender, depending on the relation between tax revenue and government expenditures. So financial intermediaries are institutions that connect borrowers and lenders. The five things, invest bankers, kind of Goldman Sachs or Merrill Lynch. Firms managing funds for investor. They manage several mutual funds. The last topic of the first chapter is recent trends. The first one is globalization, and it's the tendency towards a worldwide investment environment and the integration of international capital markets. The second trend is securitization. It's pooling loans into standardized securities backed like those ones, which can then be traded like any other securities. The third one is financial engineering. It's the process of creating and designing securities with custom tailored characteristics. So I tried to learn this financial engineering in this semester, but lots of maths and things to remember. So the professor said the person who major in maths or physics are good at financial engineering.
Actually, we will cover some financial engineering in this class. And I'm 100% sure that everyone can follow, and I believe that even if you are not good at math or stat, I think you can still be a good financial engineer.
Yeah, I hope to. Anyway, the last thing of the first trend is computer networks. It's an online training connecting customer directly to a broker account. Have you ever heard about HTS? It's a home trading system. So maybe lots of Korean investors use HTS when they're using smartphone or such network. Is it too boring? Because it is introduction of the financials, so lots of terms you need to remember. So I try to make interesting, and I put some pictures on the last page, so maybe better than before. The second, markets and instruments. The goal of second chapter is separate by 3 topics. And the first one is distinguish among the major assets that trade in money markets and capital markets. The second topic is describe the construction of stock market indexes. Then calculate the profits or loss on investment in options and fund contracts. So what is money markets? It is a subsector of debt market. It consists of very short-term debt securities that are highly marketable and relatively low-risk debt instruments. They said all things are kind of money markets, and you heard about treasury bills on the CNBC. It's a short-term government securities issued at a discount from face value and returning the face amount of maturity. I didn't remember lots of things of treasury bills, but it's very good at making turn it into the money. So is it liquidity? And CD is bank time deposits, and CP, commercial paper, is short-term unsecured debts issued by a large corporation. And bankers' acceptance and Eurodollars, and repos and brokers' calls and federal funds and legal markets. And legal market is lending rates among.
There is a question from the floor. Yeah. What's the repos and reverses?
Huh?
What's repos and reverses?
It's short-term sales of government securities with an agreement to repurchase the securities at higher price. And the next, legal market is lending rates among bankers and London market. Next thing is bond markets. The bond market is composed of longer-term borrowings of debt instruments than those that traded in the money markets. is sometimes said to comprise the fixed income capital market, but it is more straightforward to call these securities either debt instruments or bonds. And then the 5 things are kinds of the bonds. And Treasury notes and bonds, it's debts, obligation of the federal government with originally maturities of 1 year or more. The next thing, corporate bonds, it's a long-term debt issued by private corporation, typically paying semi-annual coupons and returning the face value of bonds in virtual days. Municipal bonds is tax-exempt bonds issued by state and local governments. And then mortgage securities. These securities have major components of fixed income markets and favorite agents there. The third is equity securities. Can you distinguish among the common stocks and preferred stock? And I put a picture on the right side of the slide. I can explain. The first stock is Samsung Electronics, and then the 16th is Samsung Electronics also, and the upper is a common stock, and the bottom is the preferred stock. So I will explain the differences among the common stocks and preferred stocks. Common stock is ownership shares in a publicly held corporation. When you have share common stock, shareholders have voting rights and may have received dividends. And preferred stock is don't have the ownership, but usually paying a fixed stream of dividends. As I know, the person who has preferred stock may have received more dividends than the common stocks. And then I'd like to know about the characteristic of common stock. You need to remember 2 things. The first thing is residual claims. It's the kinds of things. The stockholders are the last in line of all those who have a claim on the assets and income of the corporation. The second characteristic is limited liability. It means that the most shareholders can lose in the event of failure of the corporation is their original investment. Can you understand the 2 kinds of characteristics? I talk about the stocks and bonds market indexes. Have you ever? It's yesterday's index, and I pushed the KOSPI and Dow Jones Industrial Average and S&P 500, and I have a quiz in the slide, so but no response, no present, but I explained 3 things. The KOSPI is introduced in 1983 with the basic value of 100 as of January 4, 1980s. It's calculated based on the market capitalization. The Dow Jones Industrial Average of 30 large blue chips corporation has been computed since 1896. The S&P 500 it is basic. index of 500 firms, and it is market value weight index. And I explain price weight average and market values. And I said KOSPI and S&P 500 it's a calculated based on market capitalization, and that's S&P 500 is market value weight index. Now, how about Dow Jones Industrial average of 35? How about Dow Jones? What? How Dow Jones has calculated in the two kinds of calculation method? The answer is price weight average. It's Dow Jones has it's a good index, but to make up the risk of Dow Jones, S&P 500 was made by the market value weighted index. So those are the kinds of index in the markets. The last thing of the chapter 2 is derivative markets, and then I will explain two kinds of derivatives. The first thing is options. The second one is futures. And options has two kinds of options. The call means the right to buy. The put means the right to sell. So I'll explain. The call option is the right to buy an asset, the specific price or for specific expiration date. So when you expect the stock market is increasing, when you expect you need to buy call options, right? And when the kinds of situation happens, the put option is good derivative things to make money. Because put option has the right to sell, and then the second derivative market is the future contracts. It's ability traders to purchase or sell an assets at an agreed on price at a specific future date. Those are similar but different. So in the next chapter in the textbook, you will cover options and futures more specifically. And that's all for my presentation. Is it too short or boring? And I will show the three kinds of movies about the investments. I watch three kinds of movies also. Have you ever heard about those kinds of movies? The first one is Olderboom. So as I heard that, do you know the BBK news? BBK incident? The Kim Kyung-jun. Kim Kyung-jun made a corporation by watching these movies.
Oh, really?
Yeah.
Wow. Okay.
Let's find the newspaper.
Okay.
And then.
I mean, if you are a Korean people, I mean, those Koreans, I think you will hear or watch articles about BBK. for several years from now, I think, maybe. So I'm pretty sure there'll be a lot of work or discussion of BBK for the next several years.
And then Low Trader is a real story. And then Korean title is Gamble. It's a kind of futures market in the maybe Hong Kong markets. And then one person, because of one person, the corporation collapsed by one person because of the 깡통계좌, fake accounts. And then everyone knows about Wall Street. And then last year, the Wall Street, the money leverage slabs also released. And I watched it in Busan. And it's a kind of the explain for the director makes the movies because he wants to explain and describe the latest financial crisis. So the background of the Wall Street movie is the real story, and then the two actors go into the background. So the four movies plus Wall Street money level slabs is a good method to understand the investment theory. That's all in my question.
Any question? Okay, thank you. Who wanna do the next presentation? Chapter, I think 3.
I'll do the next.
Okay, you are okay. Gunter. How about? Okay, just a moment. Okay, chapter 3. How securities are traded. You. How about a volunteer?
I'll go for it.
Okay, thank you. I'm not sure whether you will do the presentation next class or not.
No problem.
Okay. Abdullah. Yes. What is stock and what is bond? Can you tell me the difference? Could you please tell me the difference between stock and bond? What is stock and what is bond? Can you try? Can you try? What is stock? Okay.
Stock?
Yeah.
I don't know.
Okay. How about bond? Okay.
Bond?
Yeah. Okay. 석준만. Okay. What is stock and what is bond? Actually, it is, you know, the difference between stock and bond. Seemingly simple question, but it is one of the most frequently asked question in the investment banking interview. Okay.
Really?
Yes, it is. Actually, when I did interview with Lehman Brothers, they asked me this question. And when I actually do the interview to hire people, actually I asked this question as well. Okay. Junman, could you?
Can I just take a guess?
Beg your pardon?
Can I just take a guess? I'm not sure.
Yeah, please.
I think stock.
Actually, yeah, already, Won-Young already explained it. So, okay.
I think stock is like the share of a company.
Share of the company. Okay.
And for the shareholders, like bond, I don't know.
You know the what? Yes, Adrien?
Bond is a fixed income asset, and stock is not.
Stock is not. Okay. I have more economic definition. More economic definition of them. I mean. Okay, why don't you try? You laughed, actually. So it must be a very easy question to you. So
no, I wasn't laughing because of that, sir.
Okay.
It was just different. The debt, basically, when you invest into bond, meaning you're basically just lending someone money.
Okay.
But when you're buying stock, you're actually becoming an owner of the company, a partial owner of the company. So in that market, you borrow money and they give it to you back, they pay you back. But in stock means once you bought it, you will be a permanent owner until you sell it, basically.
Actually, I disagree. I think stock is also borrowing contract. Basically, all financial securities, stock and bonds are both financial securities. All financial securities, all financial contracts are basically saying, get money today and return something larger tomorrow. Okay? So in that sense, stock is similar to, not exactly we call it borrowing, but kind of borrowing contract. It is a way of financing investments to get money from external sources to the investment for the future. Right? Yes?
Is debt and equity, I mean, stock is equity, bond is debt?
Yeah, that's right. So, but yeah, what is the economic differences between them? Stock or equity or debt and bond?
Economic difference?
Yeah, more economic. Could you please?
You mean more specific?
Yeah, more specific, more economic, intuitive way.
Repeat what you said, like part of the company and being guilty to someone. Is that what you mean?
Okay.
Maybe you can tie it to the, I mean, bond will be always tied to the interest rate,
Okay.
whereas stock not necessarily. It will be in some way, but it will be very, very indirect, whereas bond is very straightforward.
I hope you know correct answer about stock and bond question and don't fail in investment banking interview. Okay. Okay, you try.
And if the profit occurs, we just pay fixed amount of money to the bondholder, but the rest of the profit should be shared with stockholders.
Yes, right. That's the very close. So basically it is a financial contract, borrowing money, getting money today, and return something larger tomorrow. They are basically same in that sense. But one critical difference is that predictability of cash flow in some sense. So bonds or debt, they are sometimes called fixed income contract, fixed income securities, which means that cash flow in the future are kind of fixed. Of course, when a firm goes bankruptcy, cash flow is not entirely predictable and fixed, but at least in the contract, okay, bond, cash flow from bond is fixed. So they pay you coupon every 6 months, and at the maturity, they pay you the face value. Amount of the face value are fixed from the beginning, okay? From the moment of a contract. How about stock? Is it fixed? Actually not, right? So cash flow from stock is actually not fixed because it is profit sharing contract. So when a firm makes a lot of money and there is higher profit, then stock is basically the contract of a share of the profit. So when a firm makes a lot of profit, we will expect higher cash flow in the future. If we expect higher cash flow in the future, then what is going to happen to the stock price? It should go up, right? So in that sense, stock is very performance sensitive. It is very sensitive to the performance of the firm. Okay.
I have a question. Is it like the bond fixed price investment? For example, you need to invest that amount, and for a stock, like for example, if you buy a common stock, you can also invest a goodwill in there.
Yes, that's part of it. Goodwill generate cash flow in the future, so it is related with that. So basically anything that is related with future performance, goodwill, even brand, or those things, they are all relevant information about the stock. On the other hand, bond, they promise you to pay fixed amount, coupon and face value. So in the sense, that contract not that sensitive to the performance of the firm. Of course, if a firm performs very well, they will have a higher chance of paying you the coupon and face value at the end. But still, it is not as sensitive. The value of that is not as sensitive as stock. As far as a firm can pay you coupon and face value, it doesn't matter whether the firm performs even better than that or not, right? Okay, so then there is a very important implication. Okay, stock is cash flow profit sharing contract, performance sensitive contract. And bond is not performance sensitive. It is fixed cash flow. Okay, and when a firm, so suppose there are two investors for a firm. One is stockholder, okay, those who invest in stock. Another one is a bond investor. Okay, when a firm makes important decision, okay, going to China market, something like that, or going to some doing some diversification strategy. When a firm makes very important decision, who should attend the decision-making process? Bondholders or shareholders? Why?
Stock is part of ownership of
Yeah.
firm. So as an owner, we should have the meaning for crucial decisions.
Okay, so actually there is kind of a reiteration of my question, okay? So it means that when a firm, okay, stockholders are basically owners of the firm. Why stockholders are owners of the firm? Why they are entitled to make important decisions about the firm? Okay, why not bondholders?
Because the value of the stock depends on the net income of the company. So if the company makes decision to increase its income, it will profit to stockholders.
Right. As I explained to you, stock is a performance-sensitive contract. Bond is not performance-sensitive. So who have more interest in the future performance? Right? Stockholders, right? Therefore, that's why we give ownership, okay? Give the right to make important decisions. Not only the ownership about cash, we also give ownership about the right to make important decisions about the firm, right? Because stock is performance-sensitive contract. Of course, it is an ideal case, and because financial contract is not perfect, not complete in many cases. So, of course, sometimes we want bondholders to attend the decision-making process, and sometimes we also include other stakeholders, even employees or right, people in the community to attend decision-making process, because sometimes firm performance, their payoff, their interest, those stakeholders' interest is sometimes also sensitive to the performance of the firm. So in that case, maybe it is right to include them to the decision-making process. Anyway, what I want to try to say is the key difference between stock and bond is about the predictability of cash flow. One is the profit-sharing, performance-sensitive contract. Another one is performance-insensitive, fixed-income contract. Any question? So now you can all pass investment banking interview, right? So let me briefly go over what the last class, the topic for the last class. So again, it is a simple example, but it is actually what happened in Lehman Brothers. It is my simplified version of my experience in Lehman Brothers during the financial crisis. Okay, so there are good scenario and bad scenario. There are two types of bond: investment grade and high yield. And good scenario, they pay 100. Bad scenario, they pay 0. Okay. But investment grade for good bond, the probability of good scenario is 80%. And then for high yield bond, it is only 60%. Therefore, the risk neutral for the value or risk neutral value without consideration of the time value of the money is actually 80 and 60. Right? So it would be the market price when we all know, okay, what is investment grade and what is not investment grade. When we can tell the difference from the side of the seller of the bond and the buyer of the bond, when we all know, both investor and issuer of the bond knows what is investment grade, which is investment grade and which is high yield, the market price of them would be 80 and 60. But the problem occurs when there is information asymmetry. When issuer knows a bond is investment grade and higher yield, but when investor doesn't know what is investment grade and high yield, in that case, market basically breaks down. Okay? Whenever the market price is over 60, between 80 and 60, the issuer with good investment grade will simply leave the market because they don't want to sell their asset, their securities, which is value is 80, and they don't want to sell it at the price lower than 80. So they will simply leave the market. So in that case, only people in high yield, only issue with high yield bond issue only stay in the market. And from the perspective of the investor, we know what is the strategic behavior of the issuers. We know when market price is between this 80 and 60, we know bond issuers with good bond will simply leave the market, and we know only those with high yield bonds stay in the market. Therefore, we will pay only 60. If we keep iterate this process. So again, among the high yield bond, there may be several different high yield. Okay, if we keep iterate this logic, half of the high yield bond will leave the market when the bond price is lower than 60, and good high yield bond issuers leave the market and only bottom remains. If we keep iterate this logic, only the bond issuers with the lowest quality will remain in the market, and only those securities will be traded. It is simply breakdown of the market, and there is no liquidity in the market. And that is exactly what happened during the financial crisis. Interestingly, if in issuer, okay, when investor doesn't know, and in addition, if issuer doesn't know what is investment grade and what is high yield bond, actually then there will be liquidity. There will be trading in the market. When both issuer and investor don't know what is investment grade and high yield, then market price, if there is a 50 chance of investment grade and 50% chance of high yield, then market price would be 70. And both buyer and seller will be satisfied at the price, and there will be liquidity in the market. So implication is that the amount of information is not that essential to ensure some amount of liquidity or trading in the market. The more important thing is the distribution of information between the two sides. When two sides both have good information, there will be trade. When neither sides have information, still there will be trade. But when one side knows the information and when the other side doesn't have information, then there will be breakdown of the market. And there are several theoretical solutions. Okay, there are several solutions to resolve this information asymmetry problem. What are they? Do you remember? What are they, Nina? With a pretty name tag. What is the solution for the information asymmetry problem? Asymmetric information problem. Do you remember? In the previous example, okay, what kind of solution can you find to ensure the liquidity in the market?
I don't know.
Yeah, I'm sorry. Since you missed, you are not in the last class, so it must be hard for you. Who was in the last question? Who was in the last class? Okay, Angelica, do you want to try?
So we talked about two kinds of solutions.
Okay.
From different points of view. One was from economical and the other was from social.
Okay.
And social was based on trust and social network. And economic was about signaling by informed parties and screening by informed parties, and also market for information.
Right. So basically, when only one side of the market has information, and the other party doesn't have information, in that case, market is likely to break down. So somehow we have to solve that problem. Somehow we have to ensure that both sides, both buyer and seller, should have appropriate amount of information to make market work. About the solution, it depends on disciplines. In economics, they provide most influential solutions for this type of information asymmetry. The solutions are like signaling. Signaling is a strategy from the perspective of informed party. Okay? And screening is uninformed party. So uninformed party use like a screening strategy. Okay? And then sometimes we can create market for information. So we can try to find the market solution to the information asymmetry problems. On the other end, on the other side is like a sociologist. They rely on, like they use concepts like social capital, social network, and trust. And this solution is actually getting more and more important, and even economists and people in finance try to incorporate their ideas. I think you, if you have a question about like a signaling strategy or screening strategy, you can simply check Econ 101 textbook. I think they will have very good explanations about them. About sociology, they are actually it is the definition and those explanations are actually more ambiguous. I think it is, of course, they are largely economic textbook. Okay? The World Bank definition, actually, social capital is very important agenda in World Bank. Okay, and World Bank has a very high interest on the social capital. Let's see what is their definition. World Bank defines social capital as, okay, the institution, relationships, norms that shape the quality and quantity of a society's social interactions. Increasing evidences shows that social cohesion is critical for societies to prosper economically and for development to be sustainable. Social capital is not just the sum of the institutions which underpin a society. It is the glue that holds them together. Can you guess why World Bank has so much interest in social capital? Can you guess why? I mean, World Bank is dominated by economists, at least until recently. Okay? But they have more and more interest, okay, in social capital nowadays, which is a socialist solution to economic problems. Can you guess why? What World Bank does?
World Bank has a lot of hiring, something like department, and I heard one of them is trying to make some good consulting service to developing country. And I think the social capital is useful to those developing countries. So I think that reason why World Bank is interested in develop a country.
Yes. Yes, that's what they do. They try to develop. Yeah. They try to support developing underdeveloped countries. Actually, when I worked in International Monetary Fund as an intern, World Bank headquarters was next. So IMF headquarters and World Bank headquarters are like one side of the street. This side there is IMF headquarters, and the other side there is World Bank headquarters. And I happen to have chance to meet the people in the World Bank working on social capital, and I heard stories about social capital from them. Okay? Basically, the World Bank is under pressure. There is a lot of pressure from especially conservative people. The World Bank is basically wasting away too much resources. They invest a lot of money. They put a lot of physical capital to developing countries or underdeveloped countries, but there are not many performance. Developing countries are still developing countries. Underdeveloped countries are still underdeveloped. So World Bank people now realize that simply putting physical capital, simply investing physically in those countries is not solution anymore. In addition to that, because of the critics, okay, because of the critics who criticize the World Bank waste away too much money, they cannot spend a lot of physical capital as before. So they should find another solution. They should find intangible solutions. They need a solution that actually does not require a lot of physical investing. And that's why they have more interest in social capital. Social capital is basically about building trust, building social network. And it's like more intangible, right? So even without physical investment, maybe it is possible to increase the amount of social capital in the economy. And then there is a lot of empirical findings that high social capital leads to high economic growth and high development in financial market. Okay, so let me briefly explain about the social capital. So social capital, why social capital? So social capital is valuable. Social capital is basically flows and it is accumulated among social network. I think if you use Facebook, if you are the user of the Facebook or Twitter, I think you are very familiar with the social network. And those relationships are part of social capital. Anyway, social networks affect the flow and quality of information. And actually, much importantly, much information is subtle, nuanced, and difficult to verify. So actors do not believe impersonal sources and instead rely on people they know. Okay? And social networks are important sources of reward and punishment, since these are often magnified in their impact when coming from others personally known. Right? So if you are mean to your friend will hate you, right? Of course. And you will be excluded from social network. In that case, you cannot access the social capital accumulated among your friendship, relationship with your friend. Okay. So it has a large implication. Implication is that collective action that depends on overcoming opportunistic behaviors is more likely in group whose social network is dense and cohesive. Since actors in such networks typically internalize norms that discourage opportunistic behavior and emphasize trust. Right? So the more friendly, no close between the among the friends, then you will find it more difficult to behave opportunistically. Right? Another one is the strengthening of the weak tie, source of new information, diffusion, and maintenance cost. Right? The important implication is that not only strong ties in social network, people in the social network researchers use a lot of strange language. Thai is one of their common languages. Thai is basically relationship with others. Implication is that maybe strong tie is important. If you have a strong tie with others, like family or close friends, that is of course important, but not only those strong ties. Actually, weak tie also matter, because if you have a very light relationship with someone, that relationship is actually easier to maintain. The maintenance cost of the relationship is actually much lower than the strong tie. And in addition to that, it is very easy to expand your weak tie. And sometimes weak tie is the relation between someone with a very different background or different interests. So it can be even source of new information. Right? So weak tie, not only strong tie. Actually, weak tie can be actually even more important than strong ties. And another one is important of a structural whole. I mean, your position in social network is actually can be very important. Right? Suppose there are 3 people, A, B, C, and A, B, C all know people. A, B, C all know each other. Then there is no advantage or disadvantage between the 3 people. But suppose people B knows both A and C. People B have a relationship between both. Person B has a relationship with both A and C, but suppose A and C doesn't know each other, and naturally, person B is kind of information brokerage between A and C. B is even information hub between A and C. So it means that basically it matters what is your position in the social network. Okay? That can determine the amount of social capital you personally have. Another important one is the interpenetration of economic and non-economic action. Okay? So economic relationship can be influenced a lot by non-economic action, because non-economic action can form social network, can affect the strength of the tie relation between other people, and that relation can actually impact economic payoff on economic relationship. So they are highly related to each other. So example of the social capital, like a job searching process, recruiting and information about job. About job searching or recruiting process, I think Korean society, Korean system is much more fair than US or, I don't know, European system, but at least against the United States. I mean, in Korea, when big firms try to hire people, they have a very fair, in some sense, a very fair system. They have a centralized, they accept application centrally through the web, and HR department screen the document first. Sometimes they get together those applicants and make them take the exam and score them, something like that, and do the formal interview process and hire people. That's a typical Korean way of hiring people. That's very fair, right? It's like entering the university. But in United States, the better job, the better paid job you apply, the more you think, the more you will find the personal relationship matter. Okay? When you try to apply investment bank or good financial institution, of course you can apply those forms through like career web page. Like go to their web page and download the application package and upload it again. That's one way. But usually that kind of strategy doesn't work in United States. You have to have a personal contact. You have to have a personal relationship with the people in the target company. Right? So in some sense, the United States system is much more informal and less fair. Okay? So the role of the social capital is actually more essential, of course, in United States than in Korea. Of course. But even in Korea, for a new employee, for fresh graduate from college or graduate program, maybe personal ties or social capital is maybe not important. But when you try to change your job, okay, in that case, actually, again, social capital gets important. Another one is like a clientelization, and law firm client relationship. Okay, law firm and client, they have like sometimes they have exclusive partnership. Okay. So instead of like just economic relationship, sometimes they have very long-term relationship. So instead of a long-term relationship, law firm can provide lower fees. Okay. So social capital matters for law firm. And P2P used car transaction, like used car transaction. In United States, most of used car, 1/3 of used car transaction occurs from between people to people, not through commercial organization or institute. And people who trade used car with personal tie, actually they feel more satisfaction. Another one is Broadway musical. Create artist network and Broadway musical, like creative, financial, and artist performance. They are all related with social capital. So if a Broadway musical is developed by a person who has very good social network, and it is likely that the musical is more likely to succeed not only in financially, but also in among the critics. Okay. I think this is enough for the social capital. Do you have any other questions about social capital and social capital as a solution to the information asymmetry? Yes.
Financial industry of United States, why are those people very afraid of the term socialism? Because they're...
Socialism?
Yeah, they're very afraid of it.
Very afraid of it? Given my experience, they don't care. I think.
Because, for example, because it's well known that those people working in financial industry, they will be quite well off.
You're right.
So when you're trying to impose the social capital or social kind of system where everyone is more or less equal, that's when they basically lose their positions, their well-off positions. So that's why, there's this Michael Moore movie called Capitalism, a love story. So that's when he was talking about social, he's like, capitalism seemed to be very appealing in the very beginning in 70s when everyone was getting richer. And then when things got worse, people started talking about socialism. Whereas the financial industries, they would be like, no, there can be no such thing in states. Why is it so?
Okay, it is a complex question. First, there is clear distinction between social capital and socialism. They are not that in some sense related. For example, there is a research that the climax of the capitalism is not nowadays. The climax of capitalism, people say it is 1950, from 1950 to around 1960. Many people say that was the climax of capitalism. And there is a research that the social capital, amount of social capital in US was maximum at that period. And people find that even for the development of the capitalism, many researchers argue that social capital is important. Okay? So actually social capital, the relation between people, can actually help to build better capitalism. And actually that's why World Bank has so much interest in social capital as well. And Wall Street people may hate socialism. I don't know. The immediate answer would be, since they make so much money, under socialism, under socialism, maybe they have to give out, return a lot of what they made, so maybe they hate it. But on the other hand, George Soros is very famous hedge fund manager, and he has very socialistic view about the society. So I don't know. First, arbitrage, okay? I think you all know what it means by arbitrage, but let us have a more operational and slightly more rigorous definition about arbitrage. So whatever contract, financial contract or securities you have, it will generate cash flow. Okay? Cash flow today and tomorrow, 1 year later, 2 years later, something like that. And when you buy a financial contract, the first cash flow is likely to be negative, right? When you buy a stock, you have to pay for that, right? So usually, when you take a long position or when you buy a financial contract, C naught is likely to be negative number, and those are likely to be positive. Okay? So when in this context, arbitrage means for those times greater than not today, okay, for those k greater than equal to 1, when those cash flow is non-negative, greater than equal to 0, then the initial cash flow should be non-positive. Okay, it is natural, right? If you expect to receive something is at least as valuable as 0, then you have to pay at least as much as 0, right? So it is very natural. So it is a weak form arbitrage, and you can make this arbitrage definition slightly more strong. For all the k greater than equal to 1, okay, when they are all positive or all non-negative, and if at least one of them is strictly positive, okay, then what should be the price of this contract? It should be, actually not price. The initial cash flow should be strictly negative, right? If you expect to receive something strictly positive tomorrow, you have to pay strictly negative today to acquire that asset. Right? So it is a very intuitive definition, and it is a weak form and it is a strong form arbitrary condition. Arbitrage actually, it's arbitrary definition. Oh, next page. So let's apply this arbitrage argument to price the most basic asset, the most basic financial contract. Suppose there are two interest rates. Usually we have two interest rates. Okay, RB is borrowing rate from your perspective. So therefore it is a lending rate for bank. Rate charged by bank for lending. Okay, it is interest rate you have to pay when you borrow money from Shinhan Bank. And RL is the interest given by bank on deposit. Right? So it is borrowing rate from the perspective of the bank. And it is lending rate from your perspective. You lend money to the bank and you receive something for that. Okay? And usually RB is higher than RL. Right? That's the business model of the bank, right? They make money because of this spread between borrowing and lending rate. And there are a lot of economic theory what explain the spread. I think we can discuss that later. But anyway, suppose there is spread between borrowing rate and lending rate. We know borrowing and lending rate. And the most basic financial contract. Suppose there is a financial contract such that you pay P today and you receive A next year, right? Very simple financial contract. And A is the given amount. A is like $1, for example. Then our question is, what should be the P, right? So it is the value of financial contract. Well, it is actually price of this security. So what should be the price of this security that pays fixed amount A in 1 year later? To find the price of these financial securities, we can apply this arbitrage principle, right? So suppose you take a long position of this financial contract. This means you want to buy this contract. In order to buy this contract, you pay P today, right? And you receive A tomorrow, 1 year later. In order to pay P, suppose you don't have any money, then you have to borrow P from the bank, right? Therefore, to buy this contract, you borrow P from the bank, so you have a plus P. Since you borrowed money from the bank by P, you have to pay money by P multiplied by 1 plus RB, because RB is borrowing rate. So it's cash in, cash out. On the other hand, since you have long position on this financial contract, you borrow money P, and you have to use that money P to buy the contract, so it is minus P. And because as contract specifies, you will receive A tomorrow. Right? Any question until now? Then to apply this arbitrage condition, C not 0, which means that, so what is the aggregate cash flow of today? Aggregate cash flow is plus P minus P. You borrow P and you invest that P in the securities contract. So you have initial cash flow 0. 1 year later, we don't know. Okay? It depends on P, right? P is something we don't know. Okay? We have to calculate P. So apply this arbitrage principle. Today's cash flow is 0, which means that tomorrow's cash flow should be positive. If tomorrow's cash flow is positive, everyone wanna take this position, right? So tomorrow's cash flow shouldn't be positive, should be non-positive. Therefore, tomorrow's cash flow, 1 year later cash flow is A minus, okay? Okay, so to add, let me try. So, okay. Let me experiment, okay. To add this and this, okay, then we have, yes, we have A minus P, 1 plus RB. This should be non-positive. Therefore, P should be greater than equal to A over 1 plus RB, right? So, at least the value of this financial securities, the price of financial security should be greater than that. Okay, so it is a lower limit of the price. Then what is the upper limit? Actually, we can take the opposite position about this contract. Now let us take the short position. Short position means that we have to sell. So we sell the securities at the price P, but instead we have to pay A 1 year later. So plus P minus A, right? Now you sell the contract, so it is, you have a P, and you can invest that P. Actually, you can deposit that P in the bank. So it is minus P. And the deposit rate, lending rate from your perspective, is RL. Therefore, you will receive P multiplied by 1 plus RL. So again, initial cash flow is 0. 1 year later, you have minus A plus P multiplied by 1 plus RL. So again, to apply arbitrage condition, the P should be less than or equal to A over 1 plus RL. Now you have therefore upper limit and lower limit of the price. The price should be between this and this. And any price between these two satisfies the arbitrage condition. Okay? And the exact location of the price P between these two maybe depends on the supply and demand about this financial contract. Okay. Okay. Let's slightly extend this argument. Now suppose there is now we have a slightly more complicated financial contract. Okay? In the previous slide, we have only one cash flow. 1 year later, we will receive A. But now, 1 year later, we will receive A1. 2 years later, we receive A2. And M years later, we receive AM. And to make problem simple, let's assume interest rate is R. which is equal to both borrowing and lending rate. Okay, so let's assume that there's no financial transaction cost of borrowing and lending. In each case, borrowing rate and lending rate are all same, and let's assume they are R. The interest rate is R. Okay. And although this financial contract is slightly complicated, we can still apply the previous logic. If we buy this contract, okay, we have to pay P, right? Once we pay P, then we have the right to the cash flow. So we will receive A1, A2, and AM until the maturity, okay? Now, since we receive, okay, so in order to buy this contract, we have to borrow P, right? We need financing to buy this contract. So we need to borrow P from the bank. And since we borrowed P from the bank at the maturity, we have to pay to the bank this amount. P and interest rate accrued, okay? And in the middle, on the other hand, from the contract, we will receive this cash flow. And whenever we receive cash flow, okay, we deposit that cash flow in the bank, right? So when we receive A1, we deposit A1 to the bank, and the bank will pay me back A1 multiplied by 1 plus R M minus 1. We keep iterate this, okay? Then what's going to happen? So this whole period, the all cash flow is 0, right? And the sum of the cash flow at the maturity, it depends on the P, okay? And P is exactly what we want to calculate, okay? Therefore, to apply the previous arbitrary condition, since the cash flow is all 0, just before the maturity. At the maturity, the cash flow should be 0 as well. If it is not 0, if it is positive, everyone wanna do this transaction. If it is negative, everyone wanna do inverse transaction of it, right? So final cash flow should be 0 as well. And to add this cash flow at the final period, then we have this equation, right? We have this equation, and P is what we wanna compute at the end. Therefore, divide each side, move this one, and divide each side with 1 plus R M. We have this very familiar equation called discount cash flow approach. Right? Any question? Very simple, right? This is something you will learn at Finance 101. Okay? Now, let's be slightly more complicated financial contract. Now, floating rate bond. Okay? In the previous example, we know exactly the amount of the cash flow at each period. Now, let's assume that it depends on the interest rate. Okay? Floating rate bond means the financial contract that pays coupons based on the random or floating rate 1 period before the coupon date, right? So actually it is the usual, actually it is very similar to usual bank deposit, right? So if you deposit $1 in the Shinhan Bank today, 1 month later, they will pay interest rate that is prevailing this month, right? And 2 months later, so today is March 11th, right? So therefore, 1 month, if you deposit $1 in the Shinhan Bank today, then April 11th, they will pay you interest rate that is available, that was prevalent during the March, right? And the next month, which is May 11th, again, they pay you interest rate. Actually, which is now prevalent during the April, right? So we don't know exactly what will be the interest rate, market interest rate at April. But anyway, we know that whatever the interest rate, Shinhan Bank will pay the interest rate of that month, right? So exactly, they pay the interest rate 1 period before the coupon rate, prevailing that previous month, prevailing previous year. So that is typical bank deposit contract. Okay. Actually, bank deposit contract is economically same to buying a bond. Okay. So anyway, so it is a floating rate bond. Therefore, if you invest P, and then suppose F is the face value, okay, then 1 month later, they'll pay you the coupon, which is equal to the interest rate prevalent this period. Okay, so R0F. And 2 months later, they pay you interest rate by the amount R1 multiplied by F, and the interest rate prevailing this period. Okay, and of course, at the terminal date, they pay you principal first, F first, and they will pay you the interest prevailing, okay, 1 month before, okay. Then the question is, what should be P? Okay, what should be P? What is the P? Can you tell me your intuition? Actually, you even need to apply arbitrary approach. We should be able to tell the answer right away, intuitively, without any mathematics, what it should be. Yes?
The interest rate of the last month plus 1 plus the interest rate of last month, maximum.
So P should be same to this one. But problem is,
low.
Then what?
Then from
this one?
no.
What should be P? So P should be the discounted cash flow, present value of this all cash flow. Problem is that we know this one because it is interest rate of this month. We know this, but we don't know what is R1, R2, and RT minus 1. Okay. So you wanna calculate present value of this final cash flow, which is not certain. But actually, we can tell the answer upon the intuition. What it should be. When no one answers, okay, then Park Juyeon. Yes, what do you think is the answer? If you don't know the answer, could you please describe the approach to solve this problem? Yes, please.
Before that, please show the lecture.
Yes.
Yeah, we don't know the future cash flow. It means we don't know interest rate of the future. But one thing I'm sure is the investor must pay for their uncertainty. Yeah. Investor who he doesn't know how the interest rate goes up or down, but he decided to invest, and market will pay for it. So I think P is calculated assuming that interest rate will goes down.
Good try, yeah.
Says the investor must be paid for his bearing the uncertainty.
Okay. So your intuition is that there is a risk, we don't know interest rate. So the risk about the interest rate should be considered. We should take into account the uncertainty of the floating rate for the price of the P, right? To come to P. Actually, that is good try, but wrong. Actually, interestingly, this contract is no risk. That sounds strange, but this contract is actually almost no risk in some sense. Actually, consideration of the risk is actually not important in some sense. It is irrelevant to compute P. So we don't care risk in this contract. Okay, the answer is F. P should be equal to F. Actually, I'll explain to you again later. I mean, okay, it is very straightforward. If you invest F today in the bank, right? Then 1 month later, they will pay this one as interest rate. When you deposit today, multiply interest rate. And 2 months later, they'll pay you interest rate, your amount of deposit and interest rate for the previous month. And the last period, they have to return the whole amount of the F and the interest rate of the previous, right? So P should be F, right? So actually risk is irrelevant, but let us show this very analytically using arbitrary condition. The approach is basically to use a swap contract. We will learn more about the swap contract, but the idea is very simple. All those cash flow is uncertain, right? We know this one, but we don't know this, right? One idea is that we want to transform this random floating cash flow into fixed cash flow. Okay? Change floating cash flow into the fixed cash flow. Once you have a fixed cash flow, we can calculate discounted cash flow as the previous slide, right? So implicitly, we are applying swap contract, changing floating to fixed, and calculate present value of that fixed cash flow. The swap sounds a bit daunting, right? Sounds scary, swap, right? That's the devil in the financial crisis. Some people say credit default swap. But swap is very simple, don't worry. Yeah. It is simplest, very simple contract. Anyway, so let's divide and conquer, right? Divide and conquer, which means that instead of calculate all cash flow all at once, let's calculate the present of the cash flow one by one. If we can calculate cash flow present value one by one, and at the end we can simply add them all, then we will have the price P, right? Oops. So T period later, let's single out one cash flow. Cash flow at time T. Cash flow at time T is RT minus 1 multiplied by F, right? Then how to transform that cash flow as the fixed cash flow. So let's think that it's one separate contract, one single contract. So if you pay PT, then you will receive RTF. And basically you want to calculate PT. And once you did all this computation, you can simply add this all PT, then you will get a price of this contract, right? So suppose you buy this contract, then you pay PT. So it is negative PT. And of course, because of the contract, you will receive RT minus an F, right? And let's assume we borrow alpha and pay it back up to T minus 1, okay? And if we borrow alpha today, and this contract says we have to pay minus alpha 1 plus this amount. But let's assume we borrow money at fixed rate, right? And today's interest rate is R0, right? And so if we borrow at fixed rate, if we borrow alpha, then at time T minus 1, we have to pay alpha 1 plus R0 power of T minus 1, right? Any question until now? We know R0, right? R0 is a fixed today's interest rate, right? And so we have to pay it alpha 1 plus R0 T minus 1. And on the other hand, okay, we have this alpha today, and suppose we lend this alpha up to the maturity, up to time T, okay? Again, using fixed contract, fixed rate contract. So we deposit alpha, therefore we will have what? Alpha 1 plus alpha to the power of T, okay? T, right? So the only difference is T minus 1 T, right? Something like this. And then at time T minus 1, since we borrow alpha and we have today, and so we have to pay back this amount at time T minus 1, right? So we need money at T minus 1, right? Therefore, at T minus 1, to finance this amount, okay, then we have to again borrow this amount at time T minus 1, okay? And then we borrow this amount, then because interest rate between T minus 1 and T is RT minus 1, then we have to pay this amount back at time T, right? Any question until now? Right? No question. No question.
So the assumption is still that borrowing and lending rates
Are
equal,
same. Yeah. Let's assume there is no financial transaction cost. So borrowing and lending rate are all same. When borrowing and lending rate are different, this computation will be slightly more complicated, of course. Any question until now?
Sir, in the last one, when we borrow alpha r plus 1 plus r0, the last one, it's still, you know, it's not deterministic because the rate is t minus 1.
Right.
Plus a plus on there.
Right, exactly. A good point. Still, we don't know this amount, right? We don't know this amount, but it doesn't matter. Okay, we will need this amount at this time, and at t minus 7, at t minus, although we don't know this interest rate today, at t minus 1, we will know what will be likely to be, right?
Oh yeah.
Yeah. So at t minus 1, we know this interest rate, and although we don't know today, we will know at t minus 1, and we assume that we can at t minus 1 we can borrow and lending at rate rt minus 1. Okay.
Let's say that RT minus 1 will be so much greater than R0, so meaning we will end up paying more, you know, to repay the debt.
We don't know.
Can we adjust it then? Within 1
No, we don't have to. We don't have to. Yeah. It is some interest rate, we don't know, but will be prevalent at time t minus 1. Okay. And it can be higher or lower than the R0. That question is about term structure of interest rate, and we will discuss that shortly. Okay. Okay, so from this transaction, basically swap contract, changing floating cash flow into the fixed cash flow. So it is basically we are manufacturing swap contract. And yeah, let's add the cash flow. At time 0, we will have minus PT, same to the original, right? And in this cash flow, we will need this one and we borrow this, so it is 0. And at time t, okay, we will have cash flow, sum of this one and this one, this one. Okay, so at time t, we will have a cash flow. Let's add them all. Right, something like this. So we don't know this cash flow, right? We don't know what would be this cash flow. Do you know what? What is the risk in this cash flow? Which part we don't know? Right, alpha is something we determine today, right? And this interest rate is interest rate of today, we know. But we don't know what is RT minus 1, right? So one idea is actually we can change this alpha appropriately and get rid of this risky part. Hedge away this risky part. Let's try. So let's correct the terms related with RT minus 1. So it is F minus alpha minus 1 R t minus 1 plus something, okay? That part is actually not important, okay? So we want to change, okay? Am I right? Am I right? Okay. Actually, let's write it down. If we write it down, then what we have, it is a minus 1, something like this. Am I right? I think right. Yes. So we wanna determine alpha appropriately and get rid of this risk term, hedge away this risk term. Then what it should be? Then it means, okay, it means this term should be equal to 0. Oh, nice color. Okay. Yeah, we will have that one, and which is exactly this one. Therefore, alpha should be this amount, right? So if we take this alpha, this amount, then final cash flow is, there's no risk in the final cash flow. Now, by determining alpha appropriately, in the previous table, now we have absolutely no risk. That's why I argued risk is irrelevant in the pricing, okay? Because that risk can be perfectly hedged away. So it shouldn't be relevant in the pricing, okay? So by plugging this, so this term is 0, and plugging this alpha to this one, so we have a final cash flow, right? So this final cash flow at time t is simply this one, right? Right, so we plug in alpha to this equation. So final cash flow is simply R0F. Actually, that's very interesting because in the previous slide, okay, now we can pay PT and we will receive something unknown RT minus 1F. So exactly same, the contract with exactly same value says that you should pay R0F at this price. And we know what is the value of the contract that pays a fixed amount R0F. So we can calculate PT. Once we can calculate PT, we can add them all, and then we can calculate present value. Okay. So overall contract says that pay PT at time 0. Okay. Pay PT at time 0 and receive R0F at time t. So we transform all the floating cash flow into the fixed cash flow, R0F. Now we can calculate net present value. Okay. So therefore, fair price of the PT is natural. We receive R0F and discounted with interest rate today, discounted up to time t. So divide by R1 plus R0 to the power of t. And then we can add this all contract until the end. So the value of the coupon is simply this part, right? Value of all the coupon is simply this part. Value of each coupon is equivalent to R0F, and each one can be discounted with this amount, and we add them all from 0 to the maturity. And this is something we can do. It is high school math. This is this. This can be simplified to this one. But we missed one thing. We didn't take into account the fair price of the face value. At the end, you will receive the face value as well, which is F, which is already fixed. So the present value of the F is F divided by 1 plus R0 to the power of t. And by adding this part and this part, this cancel away. So P should be equal to F. Okay. Any question?
Can we just use financial calculator?
Why do you need financial calculator? It is so easy to. So even if you can use a financial calculator, if you don't know how to transform the floating cash flow into the fixed cash flow, you cannot do the pricing because you don't know what would be the interest rate of the future. Right. Of course, for this part, from here to here, of course, you can use a financial calculator. That's all. That's all financial calculator can do. Okay. Any question? So now you already learned what is a swap means. Okay, it is called like a vanilla swap. Okay. Any question? No. Next, we assume we know interest rate, and we assume interest rate is fixed, but actually interest rate can be different across time. Interest rate always changes, right? Bank of Korea increased interest rate yesterday to tame inflation, okay, inflation concern. So interest rate can be different across time. Then we need a concept that relates the time and interest rate. The most powerful one is term structure of interest rate. This is basically term structure of interest rate is basically relationship between interest rate and maturity. Okay, so this x-axis is basically time to maturity, and y-axis is basically interest rate to calculate present value. So, for example, if you receive something $1 at time t, then $1 at time t, then present value is you have to discount it with the interest rate for this contract. And for this contract, let's say it is ST. And you will have to multiply minus t. So this is the present value of $1 at time t. So this y-axis is simply plotting this one. Okay. The discount rate, not discount rate, actually. It is called the spot rate. Okay, spot rate of the contract that paid just $1 at time t. Okay. So this graph, this relation between t and st, spot rate, this curve is called yield curve, right? Term structure of interest rate, simply the structure of this yield curve. Okay, any question until now? Okay. So again, we have to be careful about defining spot rate. Spot rate meaning the interest rate charged for lending money today until period t. Okay, then how do we know about spot rate? It is very simple. If we know what is the value of $1, the value of a contract that pays $1 at time t today, then we can recover this spot rate. Suppose this D0t is the price of the $1 that will happen in t times later. Let's say it is this one. And simply this spot rate satisfies this relationship, right? Therefore, spot rate is simply st equals this one minus 1 over t and minus 1. Right? And st is usually quoted on the annual basis, which means that when we measure time, this t is usually by the year, 1 year, 2 years, something like that. So if a contract pays you $1 and 6 months later, then in order to calculate spot rate, this t should be 1/2, 0.5, right? Then you can calculate spot rate. Now forward rate, okay? Forward rate is spot rate, basically spot rate in the future. Okay? So interest rate agreed today. So it is today, alpha is tomorrow, beta is the day after tomorrow, something like that. So it is the interest rate agreed today. So we know the value of this interest rate. Already today for lending from period U to period V. So from period alpha to beta in this case, okay? So it is like interest rate like this. Suppose you go to Shinhan Bank today, and you can say to the people in the bank that, okay, I don't need money right now, but I will need money 1 year later, and I will pay back money in 2 years later, okay? Then how much interest rate I have to pay you today, something like the question, something like this, okay? Again, you go to Shinhan Bank and say, I don't need money right now, but could you please borrow money 1 year later, and I return some money 2 years later, and what would be interest rate? Then what would be the answer from Shinhan Bank? Actually, they will ask you out, maybe. They don't have that kind of interest rate, right? The immediate answer would be, well, you don't need money right now. Then why don't you come to our bank 1 year later and borrow money at that time, right? That would be 신한bank's answer. But then, of course, your answer should be, in that case, I don't know how much I have to pay 1 year later, so I want to know interest rate right now. That would be your answer. Then 신한bank will say, then please leave the bank. Like this, right? But that kind of interest rate is actually very important for your planning. Okay, so even though 신한bank doesn't officially announce that interest rate, actually you can guess. You can exactly know. What would be the interest rate by taking account, by investigating their other contract. Do you guess how? Can you guess how? Although 신한bank doesn't let you know the interest rate, forward rate, borrowing money 1 year later and return it at 2 years later, you can still know the interest rate. Almost surely. How? Actually, that is simple, okay? One strategy is actually, okay, what you can do is you borrow money for the 2 years. You go to 신한bank today and borrow money for the 2 years, okay? Borrow money 2 years. So if you borrow money, then you have money today, right? And you instantly deposit that money for 1 year, right? In that case, 1 year later, then you will receive some money, and then you will instantly, okay, right, deposit it again, right? So basically, you can replicate. So there is no risk in the contract. So you have 2 fixed contracts, 2-year contract of borrowing and 1-year contract for lending to the bank, right? And you can perfectly recover the contract that you need, okay? Money 1 year later and pay something fixed 2 years, 1 year later from that moment, right? Any question until now? So by applying that kind of logic, actually we can know what would be interest rate between alpha and beta, okay? So again, to use the 신한bank example again, to replicate the borrowing contract between these 2 periods, okay? First, what we have to do is we have to borrow money this whole period, right? And deposit it for this period. If we borrow money this whole period, okay, then we have to pay back 1 plus S beta, okay, which is something we know, and to the power of beta, right? If we borrow 1 beta today, we have to pay this amount at this moment, okay? And suppose the interest rate between these 2 periods is F alpha beta. The equivalent, economically equivalent contract should be we borrow money from these 2 periods and instantly borrow again from the agreed interest rate today, right? And that transaction will look like this. And both sides should be equal because that is exactly the same economic behavior, okay? Just borrowing one time or borrowing this moment and negotiate interest rate this time again and instantly deposit again at this moment. Of course, we have to do negotiate at this moment, right? That's the question, okay? And this contract. So this both sides, this side should be exactly the same, right? So to solve this one, of course, we divide each side with this one and divide. Okay, multiply power of 1 over beta alpha, and then you can calculate this part, right? And to calculate that part, it would be look like this. So forward rate is basically we can find the forward rate by using 2 different spot rates, which means that actually if we have a series of spot rates, it means that we exactly also know a series of forward rate as well. Therefore, forward rate and spot rate contain exactly same information. Another important concept is called the short rate. Short rate is basically forward rate for 1 period. Okay. Actually, when we model interest rate, we usually use this short rate or forward rate. We will learn that later part of this class. Okay. So basically, short rate is one period forward rate. Therefore, so if this is n period contract, so if you deposit $1 at the spot rate today for the n period, it will generate 1 plus s n to the power of n. Instead, alternative strategies, you negotiate forward contract today for each period, right? And for each period, you apply that contract and deposit money again. Deposit money, withdraw, deposit again, and at this moment, withdraw and instantly deposit at the negotiated rate forever. Again, both sides should be equal, so this should hold. And there are 3 theories, okay, to explain this shape of the yield curve. So, as I said, spot rate and forward rate have contain exactly the same information, right? So, actually, we can draw yield curve with the same x-axis, but we can actually draw yield curve with a different value. So, instead of drawing yield curve with a short rate, this spot rate, actually, we can draw yield curve with forward rate as well. That is also called actually that is yield curve as well. That contains the same information about the term structure of interest rate. And the next question is, what would be the shape of the term structure of interest? Sometimes it can go up, it goes up, sometimes it's downward slope, sometimes it is flat. And then the question is, what determines the shape of this yield curve? What determines the structure of this interest rate? I think we are already over 5 minutes, so let's cover that in the next class. Okay.